The contemporary structure of Cenovus Energy is the result of a deliberate, decade-long effort to de-risk the corporate entity through scale and integration. Emerging in 2009 from the split of Encana Corporation, the company initially focused on the pure-play development of high-quality oil sands assets. The 2017 acquisition of ConocoPhillips' interest in the Foster Creek and Christina Lake projects was the first major step to providing the company with an upstream, long-life reserve base. However, the most critical shift occurred in 2021 with the CAD $23.6 billion merger with Husky Energy. This transaction addressed the primary vulnerability of Canadian upstream producers, the exposure to Western Canadian Select price volatility and pipeline bottlenecks. By integrating Husky's downstream assets, Cenovus created a natural hedge, allowing the company to process its own heavy oil production and capture the refining margin, effectively shortening the value chain and reducing reliance on external egress.
The subsequent acquisition of BP's interest in the Toledo refinery in 2023 and the 2025 acquisition of MEG Energy represent the final stages of this consolidation strategy. The MEG Energy transaction, valued at approximately $3.8 billion in cash and 160 million shares, adds 110,000 barrels per day of high-quality oil sands production and enables significant operational synergies through the integrated development of the Christina Lake complex. Cenovus's integrated model operates on the principle of margin optimization across the entire hydrocarbon value chain. This strategy enhances financial performance and market differentiation by capturing margins at multiple stages. Upstream, this segment focuses on the extraction of bitumen, natural gas, and NGLs. Its primary strategic role is to provide low-cost feedstock generation and extend the company's reserve life. Midstream, encompassing storage, blending, and transportation, the midstream segment provides critical egress optionality and helps reduce costs related to diluent and condensate management.
Downstream, focused on refining and upgrading crude into various petroleum products, this segment allows Cenovus to capture the crack spread and acts as a financial hedge against volatile WCS-WTI price differentials. This integration allows the company to manage costs and maximize realizations from the wellhead to the consumer. By owning its refining capacity, Cenovus can strategically shift its focus between upstream and downstream margins depending on the prevailing commodity price environment. The upstream portfolio of Cenovus is characterized by long-life, low-decline assets that provide a stable foundation for cash flow. In the third quarter of 2025, the company achieved a record total upstream production of 832,900 barrels of oil equivalent per day, an increase from 765,900 BOE per day in the previous quarter.
The oil sands segment is the company's primary engine, contributing approximately 642,800 BBLs per day of production in Q3 2025. Christina Lake. Production reached 251,700 BBLs per day in Q3 2025, up from 217,900 BBLs per day in Q2. Foster Creek achieved record production of 215,400 BBLs per day in Q3 2025, an increase from 186,100 BBLs per day in Q2. Sunrise produced 52,000 BBLs per day in Q3 2025, remaining stable relative to the Q1 average of 52,100 BBLs per day. Lloydminster Thermals reached 96,000 BBLs per day in Q3 2025. Cenovus maintains significant offshore production, providing geographical diversity and high netback realizations. Atlantic region, anchored by the White Rose and Terra Nova fields, the West White Rose project, a major growth catalyst, achieved mechanical completion of its concrete gravity structure and topsides in mid-2025. First oil is expected in the second quarter of 2026.
Asia-Pacific generates high free funds flow through offshore natural gas production in China and Indonesia, largely under long-term contracts that insulate the company from short-term pricing volatility. Conventional involves natural gas and NGLs in Alberta and British Columbia. While smaller than the oil sands, it provides critical feedstock and captured an operating margin of $291 million in 2024. The integration of downstream assets serves as a critical hedge against heavy oil price differentials. In Q3 2025, Cenovus's downstream segment demonstrated exceptional performance, with a total operating margin of $364 million, a significant reversal from the shortfall of $71 million in the previous quarter. Cenovus's U.S. refining footprint includes the Lima, Superior, and Toledo refineries. In Q3 2025, U.S. refining crude throughput reached record levels of 605,300 barrels per day, a 99% utilization rate. Operating expenses in U.S. refining, excluding turnaround costs, fell to $9.67 per barrel in Q3 2025, an 8% decrease from the previous quarter. This cost discipline drove adjusted market capture to 65%.
The Canadian downstream operations includes the Lloydminster Upgrader and Refinery. In Q3 2025, Canadian refining throughput was 105,000 barrels per day with a 98% utilization rate. A major strategic shift occurred at the end of Q3 2025 with the sale of the company's 50% interest in the WRB refining partnership for $1.8 billion in cash, reflecting a focus on wholly owned and operated assets. Balance sheet analysis. Cenovus has implemented a financial framework designed to balance growth, debt reduction, and shareholder returns. Cenovus Energy's balance sheet as of late 2025 reflects a capital structure characterized by low leverage, strategic debt management, and high liquidity. Cenovus maintains a conservative financial position relative to its large-cap integrated peers. As of September 2025, total stockholders' equity stood at $20.5 billion. The company operates with a modest debt-to-equity (DE) ratio of 0.35. Gross debt is approximately $7.2 billion, while net debt was $5.3 billion at the end of the third quarter of 2025. Management is committed to a long-term net debt target of $4 billion, which serves as the trigger for returning 100% of excess free funds flow to shareholders. The acquisition of MEG Energy, valued at approximately $5 billion, including assumed debt, was financed through a mix of cash and the issuance of 160 million common shares. The company demonstrates strong liquidity, which is critical for managing capital-intensive maintenance cycles and project ramp-ups. As of September 30, 2025, Cenovus held approximately $1.9 billion in cash and equivalents. The current ratio is reported between 1.32 and 1.73, indicating a robust ability to cover short-term liabilities. While the quick ratio is 0.78, this is considered healthy for an integrated producer due to the high liquidity nature of its hydrocarbon inventories. Strategic refinancing has been used to extend the company's debt maturity profile and lower financial execution risk. In November 2025, Cenovus completed a $2.6 billion offering of senior notes. The proceeds were used to redeem notes due in 2027, pushing maturities out to the 2031-2036 timeframe. Investment-grade credit ratings, including a BBB high from Morningstar DBRS and a Baa1 stable from Moody's, provide the company with ongoing access to low-cost capital.
The strength of the balance sheet is anchored by 8.5 billion barrels of oil equivalent, or BBOE, in proved plus probable, or 2P, reserves. This scale supports a business plan where all sustaining capital and base dividends are fully funded at a conservative US $45 WTI floor, ensuring resilience against commodity cycles. Cash flow analysis. Cenovus Energy's cash flow profile is characterized by significant operating leverage and an allocation framework that prioritizes sustaining capital and shareholder returns. In the third quarter of 2025, Cenovus demonstrated outstanding cash generation, producing approximately $2.1 billion in cash from operating activities. A more precise view of the company's underlying performance is provided by Adjusted Funds Flow, or AFF, which reached $2.5 billion in Q3, a significant increase from $1.5 billion in the preceding quarter. This sequential improvement was driven by record upstream production, higher realized pricing in the oil sands, and a recovery in downstream operating margins. For the trailing 12 months ending September 30, 2025, the company generated $7.8 billion in AFF. This cash flow capacity supports a dividend yield that is currently estimated between 3.2% and 3.5%.
Cenovus distinguishes between free funds flow, cash remaining after sustaining capital, and excess free funds flow, EFF, which is the cash available for discretionary use after growth capital and dividends. Q3 2025 results. The company generated $1.3 billion in free funds flow and $745 million in EFF. Working capital dynamics. Periodic fluctuations in working capital can impact quarterly results. For example, Q2 2025 benefited from a $923 million release of non-cash working capital, which helped manage net debt during a period of heavy turnaround activity. 2026 cash flow outlook. Heading into 2026, the company expects its three-year growth investment cycle to transition into a period of higher cash flow expansion as major projects reach completion. Capital spending guidance. The 2026 capital budget is set at $5.0 to $5.3 billion, with approximately $3.5 to $3.6 billion allocated to sustaining capital and $1.2 to $1.4 billion dedicated to growth projects. Projected inflows. Consensus estimates suggest that cash flow from operations could reach approximately $8.75 billion in 2026, resulting in a forecast free cash flow of roughly $3.7 billion.
The acquisition of MEG Energy is expected to be immediately accretive to funds flow, adding 110,000 BBLSD of low-cost production. Total upstream production is guided to reach 945,000 to 985,000 BOED, a 4% growth rate after MEG adjustments. Incremental cash flow will be supported by first oil at the West White Rose project, scheduled for Q2 2026, and the continued ramp-up of the Narrows Lake and Foster Creek optimization projects. Cenovus's cash flow remains highly sensitive to commodity prices and operating efficiency. Break-even resilience. The company's business plan is designed so that its adjusted funds flow covers all sustaining capital and base dividends, even at US $45 WTI. Downstream recovery. Management has focused on enhancing utilization rates at U.S. refineries like Lima and Toledo to lower unit costs and boost margin capture, which is expected to provide long-term support for OCF stability. Differential impact. While integrated operations provide a hedge, every move in the WTI-WCS differential still impacts realized pricing for Cenovus's concentrated heavy oil assets.
The company's cash position was significantly bolstered by the $1.8 billion sale of its 50% interest in the WRB refining partnership, which closed on October 1, 2025. This cash injection, combined with $1.9 billion in cash on hand as of late September 2025, provides the liquidity required to pursue its $4.0 billion net debt target while maintaining its commitment to aggressive share repurchases. Valuation analysis. Cenovus Energy is frequently characterized by analysts as a value story within the Canadian integrated energy space, typically trading at a discount to its large-cap peers across several primary valuation metrics. This discount is often attributed to its higher historical leverage and more recent transformational M&A, whereas peers like Canadian Natural Resources, CNQ, are valued for their multi-decade consistency and lower decline asset bases.
Relative multiple comparison. When compared on a forward-looking basis for 2026, Cenovus maintains the lowest entry multiples among the Big Four Canadian producers. Cenovus Energy trades at a forward PE of approximately 11.9x and an EV to EBITDA multiple of 5.0x. Suncor Energy trades at a higher forward PE of 14.5x with an EV to EBITDA between 5.5x and 6.0x. Canadian Natural Resources commands a premium with a forward PE of 14.55x and an EV to EBITDA of roughly 6.9x to 7.0x. Imperial Oil often trades at the highest sector multiples, with a forward PE of 15.3x and an EV to EBITDA of 8.0x. Analysts note that while CNQ offers more consistency and dividend durability, Cenovus offers more torque to a recovering commodity price environment and operational improvements. Free cash flow yield and capital efficiency. A critical differentiator in peer group valuation is the free cash flow yield, which represents the cash a company generates relative to its market capitalization. Cenovus' current LTM FCF yield is approximately 6.2%, though this is expected to expand significantly in 2026 as major capital projects like West White Rose and the Narrows Lake tieback begin contributing to the bottom line. Suncor boasts a double-digit sustaining FCF yield of approximately 10.6%, which remains a primary support for its higher relative valuation. Peers, IMO and CNQ currently trade at yields of 7.9% and 8.3% respectively. Cenovus's capital efficiency is a leading driver for its long-term re-rating potential, with management targeting growth investments that meet economic hurdles even at a conservative $45 WTI floor.
Analyst consensus and intrinsic discounts. As of early 2026, the market consensus suggests that Cenovus is undervalued relative to its intrinsic cash flow generating potential. Price targets. The average 12-month analyst price target for CVE sits near CAD 29.68 to CAD $32, implying an upside potential of approximately 30–38% from current levels. Fair value estimates. Some discounted cash flow (DCF) models suggest an even higher fair value for CVE, reaching as high as CAD 77.63 to CAD 82.05. Which represents a 70.5% discount to estimated intrinsic value at current market prices. WACC comparison. Cenovus operates with a slightly higher weighted average cost of capital, WACC, of 9% compared to Suncor, 8.5%, and Imperial, 8%, reflecting the market's ongoing assessment of its debt-to-equity profile as it moves towards its CAD $4 billion net debt target.
Intrinsic valuation and DCF drivers. The intrinsic value of Cenovus is driven by its ability to generate free funds flow at conservative commodity prices. The company's business plan is designed to fund sustaining capital and base dividends at $45 WTI. Key valuation drivers for 2026 include a 4% year-over-year production growth rate, capital efficiency targeted at less than $25,000 per flowing barrel, and over CAD $400 million in expected annual synergies from the MEG transaction by 2028. Risk assessment. Cenovus Energy carries several major risks that could impede its growth strategy or compress its valuation. These risks range from immediate geopolitical shocks and trade policy shifts to long-term operational and project-specific execution challenges.
Commodity price and differential risk. Cenovus's financial performance is highly sensitive to the spread between West Texas Intermediate, WTI, and Western Canadian Select, WCS. Venezuelan supply competition. A significant new risk emerged in early 2026 following political shifts in Venezuela that could lead to a resurgence of Venezuelan heavy oil exports. Because Venezuelan crude is similar in quality to Alberta's bitumen, it competes directly for space in U.S. Gulf Coast refineries. On January 7, 2026, the WCS discount to WTI widened to $14.45 per barrel, the largest spread in 18 months, as markets began pricing in this potential competition. Analysts suggest a sustained 20–30% re-widening of this differential would materially compress oil sands margins. Global oversupply. Independent forecasts project a growing global oil surplus in 2026, with some estimates reaching 2.1 to 4 million barrels per day. If WTI falls below $55 per barrel and remains there, it could challenge the commercial viability of new drilling projects and put pressure on the company's aggressive shareholder return framework. Trade policy and tariff threats. Energy tariffs. Proposed 10% U.S. tariffs on Canadian energy imports would fall heavily on producers rather than consumers because they are tied to the U.S. market. Analysts estimate such a tariff could depress realized Canadian crude prices by $3 to $5 per barrel. In a worst-case scenario where producers must absorb the full cost, returns could drop by approximately $6 per barrel at a $60 WTI price level. Egress limitations. While the Trans Mountain Expansion (TMX) provides a survival route to Asian markets, it has only approximately 150,000 barrels per day of unused capacity. If tariffs force a major rebalancing away from the U.S., Cenovus would face higher transportation costs and potential bottlenecks that could further erode upstream netbacks.
Operational and project execution risk. Cenovus is currently managing several large-scale, capital-intensive projects where any delay could defer production growth. West White Rose completion. This major offshore redevelopment is targeting first oil in the second quarter of 2026. Large offshore projects are prone to schedule delays and cost inflation. Any failure to meet this milestone would impact the company's 2026 production guidance of 945,000 to 985,000 BOED. MEG Energy integration. Following the CAD $8.6 billion acquisition, Cenovus must successfully integrate assets to unlock its targeted CAD $400 million in annual synergies by 2028. Failure to realize these synergies or mismanagement of the complex Christina Lake North expansion could lead to higher-than-expected unit operating costs. Refining reliability. Cenovus's downstream segment is maintenance-intensive. Unplanned refinery outages or underperformance at U.S. facilities, like those seen in past quarters with FIFO inventory headwinds, can amplify margin erosion even if upstream production remains strong. Financial sensitivity. The company's value story relies on reaching and maintaining its $4 billion net debt target. Cycle resilience. While Cenovus funds its sustaining capital and base dividend at $45 WTI, total capital investment requires roughly $50 WTI to be fully funded. A sustained period of pricing below these floors would necessitate a suspension of share buybacks and a reduction in growth capital, potentially delaying the company's timeline for hitting its maximal capital return threshold. Conclusion. Cenovus Energy has transitioned to a phase of sustainable cash generation. The integrated model, now incorporating MEG Energy, provides a robust defense against regional pricing differentials. With a clear path towards its $4 billion net debt target, Cenovus offers a combination of growth and capital returns by maintaining focus on cost control and operational reliability.